Hello, everybody. Welcome to the Freight Buyers Club. And before we start, big thanks to Demerco Express Group for supporting this independent journalism. Today, I'm joined by John McCauley, BCO consultant, JOC columnist, and former vice president of transportation and logistics at Cargill. John, welcome to the Freight Buyers Club.
Good morning, Mike, and thanks for inviting me to join. And very happy to be able to have some good discussions this morning about a lot going on in our industry right now.
There's news breaking all around us. We're talking today, rather seismic news. The US and China have announced a 90-day de-escalation of tariffs. The US will lower tariffs on Chinese goods to 30% from 45%, and China will reduce duties on US imports to 10% from 125%. Now, the details of all this are still coming through. Apart from that US-China tariff war that's been ongoing and might restart later in the year, we'll see how those negotiations continue. We've also got a whole bunch of tariffs and exemptions from the US on most other countries. All of this creates a lot of unknowns for the months ahead if you're in the business of planning supply chains. We've got this tapestry of different rules and regulations that are developing, replacing this old world order. So what advice can you give, John, to US SME shippers about how they can balance supply and demand and manage all of this tariff uncertainty, especially if they import from Asia? What options do they have?
Yeah, I think first of all, it's good news that the US and China have been able to get to a provisional agreement on a level of tariffs that's maybe workable for both sides. So that's encouraging. And you would expect that China may well, and the US would then be looking to influence other Asian countries that have also been subject to significant tariffs to have trade discussions and bring those down as well. So if we talk Asia more widely with countries like Vietnam and Cambodia, and where there's a significant amount of sourcing also for the US, that could be a good thing as well to bring those numbers down. But the issue that people are facing is, how do I manage my near and medium term demand? And the first thing is that we've seen a surge in imports over the last 6 months, even up until the most recent month. So it's very clear that many importers have boosted their stock levels, which is fine, in anticipation of tariff increases. And that's a good thing from the point of view of managing cost. We'll see what happens on the demand side. But the first thing is run down that stock if you're an SME. That's the thing you want to do until these tariffs really start to level out and you're very confident that you actually understand what your playing field is. Then, best bet is keep your stock levels down. The other thing that's working in your favor, and we will come on to that possibly, is on the air freight side. So if you do need urgent shipment, air freight seems to be softening somewhat, so that can be helpful as well. The second thing that people need to be looking at is looking at their exposure in terms of risk for the cost of their goods. And by that, I mean, if you're an importer where you're importing fully produced product and then you're selling it, you're going to have a significant impact no matter what the tariff level is. If it's a part or a piece or part of your production, then clearly you're going to have an impact. The question is, how critical is that item for your production process? Is it readily available elsewhere? Could you source it elsewhere? So that's another way in which you can avoid some of the more punitive tariffs, assuming you can get it cheaper elsewhere. And it also, you want to look at it from the point of view of how much is that going to add to your cost of goods, and therefore have an impact on your overall profitability. So the key thing here is, Mike, you can think about, well, I'll pay the tariff. I'll know that my costs have gone up. Then the other side will be, what is the appetite of your organization to accept increases? So an increasing cost. Let's just assume that the SME in the US is absorbing all of the cost. You could then look at it and say, okay, we'll absorb that. We can pass it on. Depends on the price elasticity of the item that you produce, the competitive nature of it. Or you could decide to go further back upstream and ask your supplier to absorb part or all of that cost increase relative to the amount of the tariffs. The one thing that could well work in your favor, and I see that the US dollar is up again, so that could work, that the US dollar is regains a bit of its strength. But equally, you might decide to source in local currency. So you might say, well, I'll source in renminbi or in dollar or whatever the currency is of the country that you're purchasing from. So there's a number of different options as to how you could mitigate. But one thing for sure is somewhere along the supply chain, somebody's going to take a hit. And, it'll depend on how much you're able to pass on at the consumer end. And then how much, if you're in the B2B business, your customer, who then is answerable for also to their consumers, is able to absorb in their supply chains.
You mentioned air cargo there, John. One of the big factors for air cargo has been this big surge in demand we saw during 2024 from Chinese e-tailers, Temu, Shein, Alibaba, a few others. The US scrapped de minimis exemptions on goods valued at less than $800 on the 2nd of May. Now, we don't know if this trade deal will include any changes to this regulation, but how do you think shippers and e-tailers will respond to that scrapping of that de minimis exemption based on what we understand at the moment?
I think you need to look at what the proportion of purchase that is made is done direct. So is it, people buying direct themselves, individuals from those suppliers? And then the other factor that we're going to think about is if they're not included in the current negotiation, so if the de minimis exemptions are removed, then I think we're going to start to see a different way in which those retailers start to supply the US market, because they're not going to want to go away. They're significant players. I think there would be a lot of pressure on a competitive nature, because this would put local e-tailers in a very strong position, because that, if the Tenus and the Sheins are out of the way, then that's clearly got to give an open market for others. So I think we can see that there's going to be a different approach to the supply chain from the Chinese suppliers, potentially having warehousing and distribution based in the US. But then still they're going to have some issue around how do they then supply? Do they then, start using shipping containers and then bring over products? That's going to lengthen their supply chain and their fulfillment that they will have for their individual customers. So it will create different problems. The one side benefit I can see is that air freight demand, which is already softening, could well soften even further. So that should have a benefit for people who are struggling to get air freight right now.
Benefit for shippers, not so good for the carriers. There's plenty going on. There's so much going on at the moment. Now, again, I'm going to put the rider as things stand. Later this year, we are expecting significant port fee surcharges on China-built, owned, and operated ships calling at US ports to enter force. Avoiding these ships will be quite a nightmare for logisticians, you've written previously. What options do they have, and why do you see it as a nightmare?
Yeah, there's a few components to this, Mike. One is that, generally speaking, if you're a medium, let's say medium-size importer into the US, you're going to be using probably a couple of different services into different ports, depending on where your products end up. But you're not going to be largely single supply with one particular carrier. So you may be working with, say, Maersk and MSC, but you're probably going to be working with one of the alliances, which will have vessels that are operated and owned by Chinese interests, right? COSCO, OOCL, etc. Equally, even the Maersks and MSCs will have vessels that were built in China, but have components. I mean, who knows how far this will go, right? So if you're trying to navigate and say, all right, let's just start at the sourcing level, right? I'm buying the freight in the first instance. Who am I going to place my eggs with to have a balance across different carriers or different alliances so that I've got assurance of supply? So that's the first part of this being a nightmare. The second part is that, generally speaking, there's not a disconnect, but the people who are sourcing freight are not the people executing, i.e. making bookings, following up, chasing carriers for confirmations, etc. So when you have that, there's a disconnection just in communication. It's a natural thing that when people are going to operate and say, right, I need to book on this such and such a vessel, they'll need to know, can they book on this one? Can they not book on that one? if there's a blank sailing, which inevitably is happening, can I then go to one that is Chinese built or operated or parts or whatever? And this is going to be a real headache for people to be able to do, and the communication required to make sure they get that right is going to be very intense. So I think that we're going to see a lot of hassle involved in this, and at both the sourcing level and at the execution level. And frankly, I'm glad I'm not having to do that, because I think it will be very, very tricky. They're going to have a long list of, if this happens, do that. If that happens, don't do that. It'll be tough going. And with the amount of blank sailings we're seeing right now out of China and out of South Asia as well, this will only get more and more tricky and difficult for logisticians, particularly logisticians at the coalface, working directly with the carriers and making bookings and getting containers, etc.
We could well see quite a lot of those blank sailings being, new sailings being announced very soon, depending on where how this tariff agreement plays out and how people view it.
Mike, here's another one for you, which hasn't come up. Imagine that the administration says, well, now that we're bringing aluminium production back into the US, we're going to protect aluminium containers so that they're made in the US. And we're going to slap a surcharge on aluminium containers that were built in China, because guess where a lot of them are built?
All of them, I think, more or less.
There's probably a few around that work, but yeah, exactly. So I don't even want to go down that road, but there's, if things go the wrong direction, the administration has shown its willingness to be very creative in the way that they disrupt things.
Well,
and I'm not saying that in a good way. Yeah.
Creative in a negative sense. John, you said in one of your JSE columns that the trick to navigating tariffs or any other disruptions is managing your poison. What do you mean by that phrase?
Yeah, it's really a case that there is because, as we talked earlier, Mike, the different options that you've got around, do I absorb cost increases because of tariffs myself? Do I pass it on to my customers? Do I make my suppliers pay it? Do I share that? There's no good answer out of this. So you choose your poison, right? Do I choose this poison or that one or that one? Because all of them are poison. None of them should have happened, really. I'm not suggesting that the administration is not going in the right direction to get industries producing those key industries that are important for their country produced in the US. I think that's absolutely fair enough.
Important in the sense about your industrial base or your which also then lends itself to your security setup, right?
Absolutely. But if you even Scott Bessent has come out and said, we're not interested in bringing, I think it was toys or something production back into the US. They're looking at different things. So this sort of very blanket approach has made it very difficult for people. And that's why I'm saying, no matter what happens, you need to choose the poison that's going to best fit your business, and know that you're going to have to, something's going to be unpleasant one of the way. You don't have to kill yourself. You just have to, it's going to be unpleasant. That's all.
This was the big confusing thing. If you don't want toy production back in, well, why have tariffs on toys? If you can't produce coffee, why tariff coffee?
Yep.
Very strange. I never quite understood that myself.
No.
Are we all missing the point here a bit, John, about, we talk about the risk to trade or shipping volumes or logistics demand and how to plan your supply chain around all this. Is the real risk really stagflation or vastly lower demand? Because when you start playing around with the leading economy in the world's ability to trade with the rest of the world, there's some big risks, isn't there? And they slightly outweigh the ones that we tend to talk about, which is lower volumes and things that affect logistics demand. I mean, we're talking about big seismic possible impacts on the economy, the macro economy globally.
Yes. The specter of stagflation is something that has not really occurred since the 1990s in Japan. And the only time that the US has ever really had it was in the early 70s in the oil crisis. So the preparedness of any of those countries, and let's look at that on a wider basis than, say, OECD countries, to be able to deal with that, is pretty low. Not because they're not intelligent enough, it's just that if you haven't experienced it, then you won't know what it's like. The combination of low growth, which can be 0 point something or negative, inflation, pick your number, right? But right now, the Fed is showing that the inflation numbers in the US are well above 2%, well above their target. But the other one, which I think the US could find itself more rapidly suffering from, is unemployment. And high unemployment, consumption goes down. Inflation potentially goes up because then you have businesses going out. I'm painting the worst case scenarios here. And your economic growth goes down. So your instruments are two. First of all, the pressure is then on to stimulate growth, reducing unemployment and increasing growth. But in stimulating that, it usually stoke inflation. So if you try and attack inflation, then you will typically hit growth and unemployment. And the US labor market is very agile, as we know. So unemployment can move quite quickly. So I'm absolutely convinced that the demand side, and with that potential of at least of increase, continued inflation and potential low growth, is the real challenge that businesses are going to be facing in the near to medium term. Will the demand be there? People will have a really close eye on credit card debt, mortgage defaults, things like that, because there's only so much, as we used to say in Asia, there's only so much you can have in terms of share of wallet. People have only got so much, even assuming they've got credit, that they can spend. And if they spend it on things that they absolutely have to spend on, they're not going to be spending it on your goods, assuming they're discretionary. So I think this is the big concern, the demand side, and this specter of at least sustained inflation, if not stagflation, is a real worry for the US.
John McCauley, BCO consultant and former VP for Transportation and Logistics at Cargill. Thanks for joining me today on the Freight Buyers Club.
It was a pleasure, Mike.
And big thanks also to Demirco Express Group for supporting independent journalism. Thanks to you all for tuning in. Please do like, follow, and subscribe. There's a bell down there somewhere. We've now got over 4,000 subscribers, including 3,000 plus on YouTube alone. So please do hit those subscribe and like buttons. You're part of a growing community. See you soon.